All right, and we're live, I believe. Welcome, everyone. I'm Victoria Cummings from the Global FX Division of the Global Financial Markets Association, and I'm absolutely delighted to moderate the wonderful panel of experts we have today from a diverse range of firms to share their perspectives on the ins and outs of FX settlement risk. Let's start with some short intros then. What I'll do is I'll ask the panelists to briefly introduce themselves. Why don't we start with you, Marianne?
Hi, everyone. I'm brought to you today from Silicon Valley and so pleased to be here. And Victoria, thanks for nominating me to be part of the panel. And thanks, FX Markets, for bringing this to the stage today. My background is engineering, finance, and law. I went into capital markets, institutional finance, where I stayed for 25 years. And then in 2018, I realized that the technology exists to eliminate settlement risk. So I put together a company called Ninth Gear, where we offer an innovative solution and use intraday lending to optimize liquidity management and power FX trades so that we can have real-time gross settlement.
Thanks, Marianne. Hampton?
Thank you, Victoria. My name is Hampton Feiner. I'm the head of PMI, Payments and Market Infrastructure Policy at the New York Fed. I also chair the CLS Cooperative Oversight Committee, and I'm the chair of the Payment versus Payment, expansion of payment versus payment in the cross-border payments workstream of the G20 and the CPMI. I've been doing this for the last 4 years, and really passionate about reducing FX settlement risk. So delighted to be speaking with all of you today.
That's super. Great to have you on the panel, Hampton. Let's turn it over to you, Jerome.
Hi, everyone. Thank you, Victoria and FX Markets, for the invitation to participate in this prestigious panel today. My name is Jerome Kemp. I am Senior Advisor to Baton Systems. I recently joined Baton as a Senior Advisor. Prior to that, for the past 10 years or so, I was the Global Head of Futures, OTC Clearing, and FX Prime Brokerage at Citigroup. And prior to that, I spent close to 19 years with JP Morgan. So a career in financial markets, more on the clearing space, I must admit, than in the FX space, but a real passion for dealing with questions of robust markets and evolving technologies.
Okay, wonderful. And let's go to you, Keith.
Thanks, Victoria. I'm Keith Tippell. I head product for CLS. I have responsibility for new product development as well as overseeing our existing product portfolio. And that spans settlement, obviously, processing and data service lines. I have a background in building centralized infrastructure for OTC products, both OTC derivatives and FX products.
Super. Well, with these panelists, I think it should be an excellent panel, excellent discussion. I will just mention we do welcome audience questions, which you can send through on the website. I will look to either slot those in at an appropriate time, or else we'll save a little time at the end of the session so we can cover those off for people. So let's kick things off perhaps by starting with a little context for the discussion. As a crowd that's interested in FX, we all know that when it comes to physical settlement of FX transactions, mitigation of settlement risk is key. But what do we mean by settlement risk? Why is it so important for FX? How is it measured? What is PVP settlement? Keith, perhaps I can turn to you to give us a very brief overview of some of these foundational questions.
Absolutely, delighted to, and I'll go in summary, and then maybe we can dig into some further details. So, obviously, settlement risk at its purest form is the risk that one party to an FX transaction will pay the sold currency and not receive the bought currency. Now, as many of you are aware, currencies are often paid at different times of the day, so there could be a big timing gap between the payment of one currency and the receipt of the counter currency. And of course, the risk is you don't receive the counter currency. Now, that in principle doesn't sound, or that principal risk, as I've described there, doesn't sound necessarily systemically important in terms of mitigating the risk, but really the problem is potentially very large in terms of the size of our markets. If you look at the most recent BIS surveys, it suggests that about 18.7 trillion of US dollar equivalent of gross FX payment obligations are made every day. And the other thing to note is, of course, that a single failure, particularly if it's a material amount, as it may well be given the size of the market, could lead to a domino effect where one institution not receiving funds is unable or unwilling to make payments to other banks. So, there's sort of a contagion effect which could spread to losses throughout the financial system and, of course, affect other asset classes as well. So PVP and settlement risk are obviously very closely aligned in terms of concepts. PVP is a settlement mechanism that ensures the final transfer of a payment in one currency only happens if the final transfer of the counter currency occurs. So simultaneous payment of one currency for the other. One of the things, of course, that is worthy of noting is that the mechanism itself, in principle, from a technology standpoint, is not necessarily the hard piece. The most important piece is to have that mechanism backed up by a watertight industry-endorsed rulebook, support of the market, and including oversight in terms of regulators. So the principle of the mechanism is not particularly complex. It's the underlying mechanism, rule books, network, etc., that is the key to making PVP a fundamentally important part of mitigating risk in the FX markets.
Okay, thanks for setting the scene for us, Keith. So now that we're a bit more familiar with what settlement risk is, what PVP is, you mentioned some pretty big numbers there. Let's turn to explore the scope and extent of the risk, how much settlement risk exists unmitigated. I've done a little bit of digging. The BIS have been collecting data on settlement, FX settlements since 2019. According to a paper they published from December 2019, it's estimated that whilst a lot of good work has been done on mitigating settlement risk, about 8.9 trillion worth of FX payments remain exposed to settlement risk on any given day. And the proportion of trades with PVP settlement protection appears to have fallen from 50% in 2013 to 40% in 2019, alleged per the paper as partly due to growth in currencies that are not able to be settled via CLS, not CLS eligible, but also more PVP settlement needing to be encouraged where it is in fact available. So Keith, I want to come back to you on the CLS reference shortly, but Hampton, perhaps we can turn to you and start with some thoughts from you from the central bank perspective on these BIS conclusions.
Yeah, I mean, I would look. I think the principal risk and the replacement cost risk are both both really substantial. Whether it's 9 trillion or 7 or 6 or 5 or 1 trillion, it's still, these are multiples of the capital of many of the firms that are active in these markets. And so a large sort of principal loss due to some sort of failure would definitely be would be devastating, and as Keith said, would ripple across the system. I mean, what we do know is that there is this sort of persistent portion of the market that is not being settled on a payment versus payment basis. Some of that is because there really aren't mechanisms for currencies that are growing as part of the global FX system, which is understandable as certain economies rise in importance. Economies, of course, like China and Turkey and others. So it really is kind of a natural progression, but it does indicate that there that as those currencies increase and as those become more important currency pairs in the global system, that we really are going to have some gaps, and those gaps are going to become more evident and going to need to be addressed, because the risk is really quite large, and is something that we really certainly as a supervisory matter and as a financial stability matter is something of great importance to the central bank community and to the Federal Reserve, the New York Fed. I should mention that I am talking on my own behalf today and not representing views of the New York Fed today.
Appreciate that, Hampton. And in terms of more numbers around the settlement risk that's out there, I heard Guy Debelle mention this morning on his session that he's doing some work, Keith, with CLS to better understand those numbers. When are we going to see more numbers come out on this? The BIS triennial survey will be out again next year. Might there be some numbers around settlement risk in that?
So I think, Victoria, absolutely. I think we obviously all welcome the BIS surveys, and I know that there's quite a lot of focus in terms of evolving the surveys on an annual and a triennial basis. I think, as you note, some of the headlines from the most recent triennial survey were very noteworthy. We at CLS fairly immediately took some action. In particular, in terms of the numbers, as you know, we took the decision to collaborate, and we're grateful for the collaboration with a number of our global bank settlement members to perform a deep dive analysis on settlement risk. And I think what I'd like to note on that is, and I'd use the term carefully here, specifically what types of activities happen on value date to settle transactions. Now that work is ongoing. We've completed the exercise with a couple of firms. There's more to go. We have met with the BIS and other industry bodies to share some of those findings. We hope towards the end of this year to be able to provide broader transparency to the market, sort of in an aggregated, anonymized way across those findings. But I can share a few insights that I think are quite instructive, and overlay that to sort of the CLS context, if I may. And one of the things is that there's certain activities that happen related to what look like large gross notionals that aren't necessarily appropriate for a PVP mechanism. One thing I'd note there is that broad-based across the market and is well managed from a risk standpoint, in my personal opinion, is that there's agreements with some clients whereby there's a closeout of open market risk daily, and a resulting single currency cash movement related to the P&L of that day's trading activity. So that in our analysis, for example, represents a fairly material slice of gross notional that, in theory, you would have thought should be heading towards CLS for PVP for good risk management from a settlement risk standpoint, but actually is managed by a single movement of typically a dollar amount, for example. So that, I think that's good insight, for example, and an additional granularity that maybe wasn't previously in the surveys. The other thing to note is that in terms of some of our draft findings, for the vast majority that we can see of the gross notional for trades that are not turned to be on us by our clients, a broadly used term across the market, of course, for CLS eligible payers are indeed making their way to CLS. And so there's two broad categories that remain. Of course, there is more we can do, and we are very focused at CLS to grow further the participation in CLS settlement. I'll note, for example, that we've seen a 6% annual increase in third-party activity since 2019. So that's our ongoing focus, very much in collaboration with the broader market, to bring more participants into the ecosystem for the currently eligible currencies. The other thing I'd note as well is a focus, as you alluded to earlier, in terms of currencies that aren't supported currently in CLS settlement, and that is a major focus for CLS at the moment, in collaboration with its settlement members, to focus on expanding the currencies we support, in particular via PVP mechanisms that are optimized for those markets.
Okay, thank you, Keith. Yeah, that's some really helpful color on exploring the BIS numbers, so thank you for that. Let's turn it over to Jerome and Marianne now. Jerome, let's start with you. Do you have some views on the BIS conclusions, and in terms of mechanisms and services available today to minimize settlement risk? I'm very curious to hear how Baton is providing an alternative way to solve for settlement risk through use of its technology. Can you tell us a bit more about that?
Sure, I'm very happy to do that, Victoria, and thank you for the opportunity to speak. Baton today is already providing PVP settlement over currencies that are eligible for CLS, and as well as currencies that are not eligible in CLS today, leveraging distributed leverage technology. Baton provides that the transparency, the governance, the auditability, and the workflow that we believe compose the fundamental component parts of PVP settlement. Baton is very much focused on opening up the range of currencies that it proposes to its constituents, as well as the participants themselves. We are not in a numerous clauses in Baton relative to who can participate actively on the network. And I think, that is, really a function of, I guess, how technology has evolved. I think that when we think about PVP today, we think about it primarily through the optics of technologies and I would say market realities that existed maybe 20, 25 years ago, where we were very dependent on, centralized server-based processes, 24-hour payment cycles, and also a reliance on central bank money. I think that, with the evolution of technology, which allows for, call it the irrefutability of workflow events taking place between settling participants, which allows for on-demand settlement based on arguably frequency between two counterparties, or perhaps monetary thresholds between two counterparties. We're now in a position where, we can achieve PVP using commercial bank money on a bilateral basis between, two settling counterparties. And I think that is obviously, a major step forward in terms of how the, market has evolved today. Clearly, the numbers that Keith mentioned and that Hampton commented on are quite large. And I completely agree with Hampton that whether it's, 8 trillion, 7 trillion, or 1 trillion, where I come from, those are huge numbers. And I think, thankfully, we are now at a place where, from a technological point of view, we've evolved to a realm of possibility where we can actually, attack these numbers head on. Clearly, netting is an important part of this, and I think that netting though can only take us so far, and I think this is something to be considered quite seriously. Multilateral netting, which is available today for PVP settlement, actually can act as a double-edged sword, because if something bad happens, you do create perhaps the conditions for rapid contagion throughout the financial system. Whereas I do believe that perhaps smaller discrete payments on a bilateral basis, providing a finality between two counterparties is a viable and arguably preferable alternative. While mechanisms are available to essentially reduce the overall exposure relative to settlement, it really is being able to collapse the settlement cycle itself from a 24-hour cycle to a very discrete cycle that lasts a couple of minutes, which I think is really the key to taking PVP settlement into the next paradigm.
Great, thanks, Jerome. Yeah, that's encouraging to hear that that you think there's more that can be done in mitigating further settlement risk. But Marianne, let's hear from you now, and how lovely to have you joining the panel and able to round out the thinking here, because you're probably the newest entrant to this space. So very keen to hear how you view the current settlement risk landscape and how Ninth Gear is imagining FX settlements and seeking to provide a solution for eliminating settlement risk via the mechanisms that you mentioned earlier.
Thanks, Victoria. As I see it, we've moved from pen and paper to a computerized system, but we still haven't tackled some of the underlying problems. And settlement risk is unnecessary. We've been talking about settlement risk for years. Each and every time I come to one of these conferences, and I'm looking forward to joining everybody in person soon. But each and every time I come to one of these conferences, there's a panel such as this one we're on today, and we continue to talk about it. Living at the intersection of finance and technology is just exciting. And now is the time to implement market structures that eliminate the delays and settlement failures. So at Ninth Gear, we've reimagined FX, and the technology, as Jerome was just talking about, now exists that allows for finality of payment, as well as an immutable record with a single source of truth. So we have atomic transactions that either go all the way or not at all. And it is possible today to implement those structures. They cannot be undone. So if you make a mistake, you need to do another transaction. So also having a single ledger ensures that everybody's looking at the same source of truth. So you eliminate the breaks, the reconciliation errors, and corrections that cost so much. Oftentimes things are bundled, so you just don't know what you're paying and it's unclear. So digital solutions that improve transparency, increase investor confidence, as well as demonstrating fair treatment of all market participants is possible. And PVP is a mechanism and finality is a legal jurisdiction. So they're not exactly the same. And depending on where you are, things can be undone and a judge could rip things up. And we saw that most recently with the Lehman that went under on a Sunday night. And I do know some very large trades that just had to go to the courts to establish that and be repaid. So I think that now having things done in the moment is possible so that you can have real-time gross settlement.
Yeah, okay, thanks, Marianne. Yeah, it's interesting you bring up the legal finality element to it, and we'll be talking a little bit about the components of PVP settlement, and I think that's an important one beyond the operational syncing up of the two payments. But I think now that we've talked a bit about PVP settlement and heard your views on that, let's talk a little bit about mitigating settlement risk where PVP is not currently possible, because I think it's been identified there are certainly cases of that. Recently, as we all know, the updated FX Global Code was released by the Global FX Committee. It places even greater emphasis on the use of PVP where available, as Guy Debelle mentioned in his code overview this morning. But it also addresses management of settlement risk where PVP is not used or able to be used. So I'm curious to hear the group's thoughts on what other mechanisms beyond PVP can be used to reduce risks associated with FX settlement. What role, for example, can netting play in reducing settlement risk? And Jerome, you talked a little bit about netting just now. What about compression is another question I have. Jerome, why don't we start with you since you mentioned netting? Do you have some thoughts on how netting can mitigate settlement risk?
Sure, I can talk about netting a bit more, but I just wanted to come back to what you said about, where PVP is not available, because indeed, I think, what Baton is focused on is essentially bringing PVP, unbound, if you will. Because the mechanisms that Baton is making available to its clients essentially is agnostic as to the currency pair being settled, and provided that the participants to the platform meet eligibility requirement, there really is no limitations in terms of who can achieve PVP settlement. In the current paradigm, which is dominated by one player today, there essentially is a numerous clauses. So while PVP is possible or imaginable for a relatively small number of market participants, here we're talking about sort of the much broader universe of participants who come together to produce these astounding numbers on a daily basis. So coming back to netting, I think that obviously netting is a very powerful tool. And, I do, really stand in admiration of what CLS has achieved relative to offering multilateral, netting to the market today. But as I mentioned previously, I do think that, multilateral netting is not without risks, because there always is a chance that there something bad could happen. There could be a default. And as we've seen through multiple crises, the contagion risk when one large counterparty goes bad is quite significant. So I think that we can imagine a world where we are able to provide netting across bilateral counterparties allowing those counterparties to determine themselves when and by what means they actually choose to trigger a settlement workflow. That is essentially the focus of Baton today. So giving that flexibility, essentially bringing a new, call it sense of control and empowerment to the market, the participants in the market today, relative to the currencies that they choose to settle in. Even if we do have absolute perfect science on netting, I think that what it really comes down to is the ability to actually perform that settlement. You could have the best netting sets and the best technology operating in the background to produce that netting, but if you're incapable of actually performing the settlement itself, you've got a problem. And we've seen in certain currencies that are not eligible today for PVB, with CLS, we have seen the market seize up. I mean, in the past, we've seen TRY, come down to sort of like a shootout in Dodge City where, there, as I recall, I think there were 3 or 4 banks. No one really wanted to execute a payment because no one really had the visibility as to, the other side of the payment chain that they would be facing. And so, again, I do think that, we have to, move forward in terms of empowering, payments with this type of visibility so that, PVB is achievable across, a much broader range of currencies and market participants. Obviously, as I said, netting is a very big part of it, but at the end of the day, you do need to settle the trade. And given the recent revisions to the global code, obviously we're striving to provide that PVP to as broad a church of market participants as possible.
Keith, do you want to respond to that in terms of the multilateral netting that is done as part of the PVP service offered by CLS, and perhaps use some thoughts on netting outside PVP settled trades and what benefits netting can have to reducing settlement risk even where PVP isn't used?
Absolutely. So, and may I just address one of the points raised by one of the other presenters in terms of a small number of participants. It's well known in the market that well in excess of 25,000 legal entities have access to PVP via CLS settlement, and that's the fastest growing set of participants in terms of those going through the third-party route. So that's growing fast, and so that's a large number of legal entities across a wide range of market participants. We are, coming back to your question, we're hugely supportive and have been obviously consulted as part of the changes to the FX Global Code principles 35 and 50 in terms of the settlement risk principles. And really that describes a very elegant waterfall, which is simply PVP as much as you possibly can. And of course, there's a huge amount of effort in the market to bring PVP to a wider range of currencies and participants, and I'll come on to that shortly. But where that's not possible, to automate, and ideally automate by a centralized mechanism, the netting process for those transactions that, for whatever reason, can't be PVP. So that's very much in line with CLS's strategy, where we will provide that waterfall to our clients and enable them to be fully compliant with the settlement principles that are now published as part of that revised global code. If I can sort of transition a little bit in terms of the, what does it mean in terms of bringing PVP to a wider set of currencies? Well, we are very much in line with the work been undertaken by the CPMI FSB. CLS has actually from about the middle of last year have been focused a lot of energy and working with a significant number of our global bank settlement members on an initiative to design and then roll out an alternative PVP mechanism that we believe will support broader global adoption of PVP. In particular, making sure that specific nuances of some of the markets that we don't support from a currency standpoint today are factored into the design with a degree of realism in terms of how those markets operate, and say are optimal both for local market participants, but also our existing settlement members. As I said, we're highly encouraged by the collaboration we're seeing from our members on that, extensive contribution of their thought into the design process. And we remain, we're actively involved in terms of building block 9 and related building blocks as part of that CPMI FSB work. One thing I just wanted to note as well, and it's pertinent to that initiative. It's also pertinent broadly to PVP mechanisms. Is that technology is merely one leg of the stool. As we I can share as somebody who's been he's into his second year at CLS, and to see the extent of the underlying work that's required to run a large network, and a large network is required for efficiency reasons for market participants. For a PVP mechanism is substantial. Most importantly, I say that and much harder, in my personal opinion, than building the technology is having a robust and industry-agreed rulebook underpinning not just the happy path flows, but the non-happy path, covering in all aspects of settlement finality, degrees of enforceability, all the non-happy path flow that we have to consider. The appropriate governance related to something being that systemically important. But also, as I mentioned earlier, none of these platforms really drive enough benefit for market participants and end state unless there's broad user adoption. And it's extremely hard in the current environment to create new networks. So we're very focused at CLS as trying to leverage existing networks that we have based on years of investment between us and our membership to open up access to additional PVP mechanisms. And as you mentioned earlier, other aspects to mitigate risk in the markets, including centralized netting processes.
Okay, thank you, Keith. Yeah, I think you've raised there some of the factors that go into mitigating.
May I just?
Yeah, Jerome, you wanted to jump in?
Yeah, I'm sorry if I could just step in just for a second. I just a couple of thoughts on that, because I think that Keith, you make some very valid points about networks. But again, I think that perhaps technology is the most significant driver here. And again, I come back to the basic fact that technology has evolved, which allows for a much more dynamic interaction and interaction amongst market participants to achieve riskless settlements. One thing that we're not really talking about, and this is why I think the evolution of centralized networks to distributed networks is very important. Is really around liquidity and funding, and this is something that we really haven't touched on yet. But we do also see in the markets a very keen focus on the costs associated with funding large settlement flows, because that is obviously very much a part of settlement risk itself, as well as, I guess, the challenges to optimal liquidity management, relative to these, sort of 24-hour, continuous sort of cycles that are in place today. And again, I think that, thinking about how technology has evolved, which allows, market participants to essentially determine amongst themselves what is that optimal point in terms of, underlying liquidity from, their own point of view. What is the optimal point in the settlement cycle relative to, their funding sources and their funding cycles relative to, the broader universe of settlement activities that they do on a daily basis, that this is also a very significant consideration as well. And again, I think that the approach that new technologies such as the one that Baton is bringing to market, these are advantages and just better control mechanisms that this tactic technology offers to the market participants today.
Okay, thanks, Jerome. Yeah, so maybe I think acknowledge that technology plays a big role in PVP settlement. Maybe just shifting away from technology just for a moment, I'm curious as to other factors that go into mitigating settlement risk, and in particular, the role of nostro banks. I always get a bit confused by nostro and when you have nostros on either side, it gets rather complex. But clearly there is a role that nostro banks play in terms of access to central bank rails for those that don't have access directly. Hampton, can you perhaps tell us a bit more about the role that nostro banks play in PV settlement?
Of course. So I think, as Keith mentioned, say with CLS, there are thousands of participants, but not all of them will have access to their own accounts or their own funding in all of the jurisdictions. Of course, there are a few of the large sort of money center banks that would that do have that kind of access, but that's relatively rare. So there are networks of nostro banks which provide those sort of correspondent services to banks that don't have either the funding or the account or the presence in that jurisdiction, but still want to do FX transactions in that currency. Of course, the most important nostros are the ones that are in the most important currencies. I mean, that tends to be the U.S. dollar and the euro and the yen and the pound and et cetera. So but they are very, very important players, as many of you are aware. I think in general, so there's always going to be typically a participant will not have two nostros. They don't have backup nostros because that's expensive, and a kind of a relationship that takes a fair amount of investment in. So I think that's not a realistic expectation. So there is some vulnerability to a problem at a nostro. I think less around their solvency, honestly, but more around operational issues, et cetera. And I think in general, connectivity to some of these settlement systems is really kind of a source of can be a source of disruption. So change management at nostros and other member banks, is an area where we see disruptions, and an area I think that we should have a lot more sort of supervisory focus on is how folks maintain that connectivity as the technology becomes more complicated, as the technology becomes more important, as Jerome said, maintaining the ability to kind of the continuity of access and transactions, and really building in maybe additional alternatives and other ways of improving resilience, I think is going to be an increasing area of focus. The risks around the technology, including cyber and fraud and other things that continue to increase over time, and I think the resilience is really going to be quite important. And I think the place to start would be with nostro banks.
Okay, thank you, Hampton. Yeah, so we've covered a few different factors, a few of the ingredients to FX settlement risk there, right? Operational, technology, having a network of participants, nostro banks, legal framework, Marianne, as you mentioned. I'm sure we could spend all day delving into the different factors that go into mitigation of settlement risk. But in the interest of time, I do want to make sure that we have a chance to talk about some of the benefits of mitigating settlement risk and some of the hurdles that exist to mitigating settlement risk. Is it easier said than done? And perhaps, Marianne, let's start with you. Given that you're innovating in this space, what I think we've heard some of the benefits of mitigating settlement risk, as you've said, and even potentially eliminating settlement risk. There should not be cause for any settlement risk. Presumably, you've faced some hurdles too and challenges in the course of your innovating at ninth year. Can you tell us a bit more of your thinking or experience around that?
Yeah, sure. And I am very careful to say that this is not a rip and replace exercise, because all of these institutions are currently in market, and there's 6.6 trillion that's moving through these structures every day. So I look at what we're doing in architecting is more like a carousel. We have the market that's spinning around, and when you go on the carousel, there's lights, there's noise, there's the ponies going up and down. So I can't just stop this structure in order to insert. So what we've done, we've worked with established groups and done working on partnership opportunities so that we can ensure that there's business as usual, because distributed ledger technology is a really scary thing. And when I started talking about this in 2017, I called 100 institutions and I asked, what are you doing with blockchain? What are you doing with crypto? people laughed, except for Fidelity, who said you can use it in their cafeteria. So it's one of these things that, as Jerome just mentioned, technology is really important because you can have trustless transactions where you can trust the technology to ensure that the smart contract goes through all the way. So as we work through and are very carefully orchestrating what we're doing in the market, we're working with infrastructures and talking about a long-term view, but we're creating solutions that work today that can eliminate some of the settlement risk.
Thanks, Marianne. Do others have thoughts on benefits and hurdles to mitigating settlement risks to share with the audience?
Victoria, I'm happy just to say a few words. I mean, I think the way I think about settlement risk by a PVP mechanism is that clearly, settlement risk mitigation and the associated operational efficiency are, fundamental to it. But actually, liquidity optimization and other aspects that PVP enables, such as, for example, a materially different dynamic in terms of counterparty settlement risk limits. Those are really important aspects in terms of the benefit of mitigating settlement risk. If you mitigate settlement risk via PVP, as we do in CLS today, you can get deeply efficient liquidity optimization. To give you an example, many of our members, from a liquidity standpoint, we're netting down to less than 1% of their total gross notional in terms of from a funding standpoint. We also have been working from the early days of CLS to make sure that the risk teams at our organizations, A, understand our service, but B, because they're completely confident the settlement will happen, they can provide the benefit to the trading part of the business of a complete haircut in terms of 100% haircut in terms of counterparty settlement risk limits for CLS eligible transactions that make their way to CLS for settlement. So these are really material benefits that actually have underpinned the safe and very material growth of the FX markets over the last couple of decades, and I think will continue into the future.
Thanks, Keith. Jerome, I think you also had a thought on this?
Yeah, I did. First of all, I just wanted to shout out to Marianne. I do very, violently agree with her on her comment relative to rip and replace. I think that, whatever solutions, ultimately, do get a foothold, should not be focusing on boiling the ocean, but working with existing structures to advance the cause. And, that's certainly the case with the Baton's approach. But I do think that, I just wanted to comment on your question relative to hurdles, because I think that one of the biggest hurdles that we do face is simply one of courage to essentially, thinking about the leverage of new technologies and new approaches. It requires vision. It requires leadership. And so, to create a new normal, to create a new reality, requires, that vision and leadership. And we have seen, markets evolve, perhaps, brought dragging and screaming, because of, regulatory changes. Here, I think we're in a privileged position because essentially this is a technology-led improvement to the overall, safety and security of these markets. We do know today that the technologies that we've been discussing, can lend to, much more robust and transparent markets. But it's going to take leadership, it's going to take courage, it's going to take vision. And if we can get over those hurdles, I think we will be able to, take this space to, brand new heights. And it's interesting, we are engaged. When I say we, Baton is engaged with in discussions with various regulators around the world, and there is a very encouraging amount of openness to these discussions. I think that part of the regulatory agenda and focus, and maybe Hampton wants to comment on this as well, is these these perhaps smaller, emerging players and what they could possibly bring, how to accommodate these new voices, these new technologies, these new approaches to a very old problem, which currently we're trying to resolve.
Yeah, thanks, Jerome. And I know, Keith, you mentioned the work that the CPMI, I think it was you that mentioned the work that the CPMI is doing on enhancing the efficiency of cross-border payments. One of the building blocks of that CPMI work is PVP settlement. Hampton, I know you're quite involved with that work. In terms of the sort of industry collaborative efforts around that and around the PVP building block, what are you seeing, and how do you see the industry coming together to help expand the use of PVP settlement and the mitigation of settlement risk, perhaps through groups such as the CPMI?
Yeah, so I mean, for those of you who haven't seen the cross-border payments roadmap, there's several papers are out there. I really recommend taking a look at that. One of the building blocks, as you mentioned, is expanding payment versus payment, which I am the chair of. There's a work stream associated with that, a CPMI work stream associated with that, and it's a building block as well. The first stage was really reiterating the kind of commitment of the Basel Committee and the CPMI to the FX settlement risk guidance, which came out in 2013, which we kind of continue to remind banks, global banks around the world, that remains very solid guidance that most important jurisdictions have been implementing over the last several years, including the Fed. So really, there was a letter that went out that really reiterated that. In the second stage, which is where we're calling it Action 2, we did some stock taking. We talked to industry, many of whom are both in the audience and on this panel, about what the current state of affairs are and what folks are looking for. And that included emerging technologies. It included established players. It included ourselves, central banks, and what we've been doing over the last several years. So a very thoughtful process to really understand what's out there. And then the other part of that is really to start thinking of solutions. So no real bias in favor of incumbents necessarily. A lot of openness, to some of the emerging either emerging technologies or emerging firms that are that can expand expand payment versus payment. We have not ruled out roles for central banks to play a larger role, as well as private sector alternatives or mutually owned outfits like CLS and others. So I think there's a lot of openness to ideas. We are in the kind of early part of that stage, and we'll be talking to lots of folks and looking for those ideas to expand. And then ultimately, the last action would be would be actually to work towards really seeing some of these solutions be built and created, and soliciting comments. And insofar as central banks are can and should be involved, which is often the case with PVP, whether we're providing accounts or whether we're in a role as supervisors, that we would be helping to see that through. So it's very exciting. It's a multi-year process that will go on for the next 4 or 5 years. But really, this kind of commitment to expansion of PVP to make the overall cross-border payment space, safer and more efficient, of course. So that's really where we are with that.
That's great to hear. Those efforts are happening, Hampton. Sounds like there's some really good minds thinking about all of this. So we did get a couple of audience questions, and I think it's always nice to be able to address the audience questions. We've got 10 minutes left. Before I turn to those, I want to ask if anyone else has got some final thoughts on collaborative effort, on PVP, any must-have, need-to-knows for the audience before we try to tackle some of the questions?
Victoria, so it's Keith. So I think the one small note I would make is that if you look at the work that the CPMI is doing, and there's a huge effort going into that, and so we're very supportive of CLS of that work and contributing where we can to it. But I think that underscores to me, and we see it directly from our membership, that that there is a genuine appetite to address settlement risk and expand the use of PVP into other currencies. A, because it's the right thing to do, it mitigates risk, and B, it actually enables more business and more commerce cross-border, which I think we all agree is a good thing. So I've never seen such extent of collaboration, and I think, just as happened in the early days of CLS being formed, whatever solution is going to be broadly adopted will be some sort of combination of a public and private partnership, and I think that is the key to success, because the roles of the regulators and the central banks in the safety and the reliable running of these services, I think, will continue to be super important.
Thanks, Keith. All right, so shall we try and tackle some of the audience questions then? Let me read them out. So the first one we got was, oh, this is an interesting one. Do you think PVP is going to become mandatory to settle FX in the future? We've obviously got a encouragement of PV, pretty strong encouragement of PVP settlement in the code. Hampton, you mentioned the BCBS guidance on FX settlement risk from 2013, which again encourages, from a supervisory perspective, as much PVP as possible. Do we think there's going to be a day when it's mandatory to settle PVP?
I wouldn't think so. As Keith mentioned, there are a lot of there are a lot of very safe mechanisms that aren't PVP. So some of the on us and the single currency netting and some sort of the kind of bilateral compression that goes on that that offers at times will offer something that is really kind of as safe or nearly as safe as payment versus payment. So I think kind of mandating that every transaction be PVP is unlikely. The guidance is fairly clear, and the FX code is fairly clear that where it's available, it is to be used. And so insofar as we take this guidance extremely seriously, and it's integrated into our supervisory programs. I mean, in that sense, there is. It is strongly encouraged. Is it mandatory? Perhaps not, but it is it is vital for banks to be able to adequately manage this type of risk. So I would say very strong. We very strongly require this to be very clear. Where it is available, insofar as we've adopted this guidance.
You should be doing it where you can.
Absolutely.
Yeah.
But I would say quickly that guidance is broader. So this cuts across all the various risks and a lot of the internal risk management. There aren't real capital requirements for some of the settlement risk, but that doesn't mean that the firms should not allocate capital and manage their capital risk and their liquidity risk as a result of this, both principal and replacement cost risk. So there is a strong expectation of risk management where PVP isn't available, and which should ensure that they can operate those kinds of businesses safely.
Right. And I think, as Keith has mentioned before, there are other incentives to settling PVP and mitigating settlement risk, even beyond the most obvious risk-reducing goal of ensuring one side doesn't move without the other. Okay, so good. We've got another question here. Perhaps this is one for you, Marianne, since you mentioned DLT. What role will central bank, digital currencies, stable coins, and blockchain technology play in enhancing PVP settlements and to further reduce FX settlement risk?
So I'm happy to jump in on this. With regards to stable coins, let's tackle those first. I do not believe that stable coins are all that stable in current environments. So there are over 70 CBDC projects that are currently going on, and we're working with several of those institutions to work through those. I think that the Monetary Authority of Singapore is definitely one of the first, and they've been experimenting for 5 years on that. They're also built on Quorum, which is the protocol that we're built on. But in speaking with Daniel Gorfine and Chris Giancarlo that were previously with the CFTC, and they're now with the Digital Dollar Project. Those projects are 5 to 7 years out, and the Digital Dollar Project in particular is not going to be the first, because it needs to be, perfect the first time it goes out. So I see that there is horizontal and vertical interoperability that needs to be done to ensure that some of these projects will tackle them. I think that that's an end state that will happen, but it's not here today. So I think that there's a lot more work to be done on those, and I can spend hours talking about that in case anybody wants to direct message me.
Thanks, Marianne. Did any of the others?
Victoria, could I add?
Yes, go ahead.
Yes, could I? Yes. No, I do very much agree with what Marianne said. I think in terms of the time frames, there is a continuum here that I think we need to think about. And indeed, we're at a very interesting point in that continuum, because I think we're really, focused right now settling real money in real accounts on a PVP basis. I think that's really the task at hand that we're focusing on today. Marianne, did mention the Digital Dollar Project, which is operating under the auspices of and the guidance of Chris Giancarlo, who, I'm proud to, serve as an advisor with at Baton. Chris is one of the senior advisors to Baton as well. So, we do have the privilege of his insights to this particular aspect of the broader debate as well. I do believe over time, though, that we will see both, advance in digitized currencies, CBDC, et cetera. But will that enhance PVP settlements? I guess that's the nature of the question. To the extent that, we can essentially program in settlement attributes to these various, digitized assets, yes, I think that would represent, a perhaps, next logical step in terms of achieving, a PVP, again, the further automation of PVP. But again, let's focus on, getting ourselves fully aligned and more broadly based in terms of what we can do with PVP today, again, with real money in real accounts. And then as these other debates evolve, let's see, how we can leverage that to, better service, the stability and safety of markets.
Thanks, Jerome.
Victoria, if I can just add a quick comment from CLS on this topic. So while I wouldn't disagree with some of the comments around the timeline, actually, conversely, CLS is quite focused on this area. We're heavily involved in conversations with a number of entities, including the BIS Innovation Hub. But we're looking at, while it's I think impossible to predict the end state, and I think personally, CBDC's use cases for retail may come before wholesale markets. We are focused on a potential future state and how we'd facilitate, in particular, use cases such as how you would PVP a CBDC for a non-digital currency, etc. So actually, we're trying to get in front of this as CLS on behalf of our clients and enjoy quite interesting conversations both on the public and the private side in terms of any future state that might evolve.
Right. Okay. So clearly a lot of interesting work and thinking to be done around some of these new technologies and innovations and how to incorporate them into the PVP settlement framework. All right. So we're a minute away from the end of our session. I think we could have had another hour. This is such a fascinating topic. But I think suffice for me to say thank you very much to the panel for joining us today. I think it's been fantastic to get thoughts on this topic from a representative from a central bank, from an innovator, from two incumbents in the space. So really appreciate everyone sharing your thoughts so candidly with us. I guess, Marianne, you mentioned we hope the next time that we get together, perhaps this can be in person. I certainly miss the FX markets events that used to happen at the Metropolitan Club in New York. So perhaps by the time we get together again next year, we can all meet in person. Did anyone have any final key messages they wanted to get out to the audience in terms of the settlement risk topic? Now's your chance. All right.
Now is the time to make it happen. Now is the time to make it happen.
That's right. Yes, we'll see
Yeah.
what innovation happens over the next 12 months until we all meet again, and perhaps we can get an update on where things stand. And also, we'll have some more numbers around the settlement risk that exists out there once the BIS has done some additional digging into those numbers. I think with CLS's help, Keith, it sounds like.
That's right.
All right.
Okay. Thank you,
Thank you
Victoria.
very much,
Thank you
everyone.
for everybody
Thank you,
joining the
FX
panel.
Markets.
Thanks. Bye, everybody.
Thank you. Thank you very much.
Bye.
Goodbye.
Thank you.
Bye-bye.